I'm Andrew Murphy, Co-Chief Investment Officer at Winthrop Wealth, and welcome to our first quarter 2022 market review and outlook. In today's video, I'll review how stocks and bonds performed in the first quarter, and I'll discuss the three key issues driving the market: the Russia-Ukrainian war, inflation, and monetary policy. Please visit our website at winthropwealth.com to view the full written version and to watch our latest webinar titled Markets in Motion, which goes into full detail on these topics. As always, please let us know if you have any questions, and we look forward to speaking with you soon.
Heading into the year, we thought that volatility would increase, as the stock market basically went up in a straight line by nearly 29% in 2021. And that's what happened, as the S&P 500 decreased by 4.6% in Q1 of 2022, for the first quarterly decline since 2020. The market also saw its first correction since the pandemic, when the S&P dropped by nearly 13% from January 3rd to March 8th. But on a positive note, the market was able to stage a rally by almost 9% in the last 3 weeks of March. And these type of violent swings are why we don't believe in market timing. But if we step back a little bit further, we can see that despite the tough start to the year, recent stock market performance has been excellent. The 3-year annualized return for the S&P 500 is 18.9%, well above the long-term annualized return of about 9.7% since 1928. The bond market didn't fare any better, as the Bloomberg Barclays U.S. Aggregate Bond Index, or the AGG, which acts as a proxy for the investment-grade bond market, decreased by 5.9% in the quarter. This was the worst quarterly decline since 1980. Other areas of the fixed income market, including corporates, high yield, and munis, also posted negative returns. Throughout the quarter, the 10-year Treasury Yield increased by 83 basis points to 2.34%, mainly due to increased expectations of inflation and restrictive monetary policy. Bond prices move inversely to yields, so the increase in interest rates caused a decline in the bond market. On a brighter note, we'll highlight that the bond market's yield to maturity, or the estimated rate of return an investor can expect from a bond if purchased today, and assuming there are no defaults, has increased to 2.9%, which is the highest level in years. With the Russia-Ukrainian war, first it's a humanitarian tragedy, and we're hoping for a quick resolution. From an investment perspective, please see our client question on the market reaction to geopolitical events. Our key takeaway is one of our favorite themes: the power of maintaining a long-term viewpoint. Yes, the stock market typically sells off after a geopolitical event, but on average, it's usually higher 6 to 12 months later. Unfortunately, inflation continues to run at the highest levels in decades. The latest reading of the Fed's preferred inflation measure, core PC inflation, came in at 5.4% year over year in February, the highest reading since 1983. The increase in inflation is driven primarily by surging energy prices, supply chain bottlenecks, and strong consumer demand due to stimulus payments and a tight labor market. The latest FOMC projections show inflation ending 2022 at 4.1%, before falling to 2.6% in 2023 and 2.3% in 2024. And note that even by 2024, the Fed projects that inflation will still be above their 2% target. And before we get to what the Fed is going to do about inflation, we want to mention that we are trying to hedge the impact by holding low levels of cash in portfolios, avoiding long-term bonds, and tilting toward companies that can grow their cash flows, earnings, and dividends. The Fed has now admitted that inflation is too high and it needs to be addressed. And they'll try to bring inflation down by tightening monetary policy, mainly by raising interest rates and shrinking their balance sheet. This chart shows the federal funds rate, and after cutting rates to zero during the early part of the pandemic, the Fed raised the federal funds rate for the first time since 2018 at their March 16th meeting. The Fed now projects that they will raise interest rates by 7 times total in 2022 and 4 more in 2023. We also think it's important to note that although monetary policy is tightening, the Fed still believes that the economy is very strong and that a recession over the next year is unlikely. Chair Powell's assessment that the Fed can raise rates 11 times over the next 2 years and avoid a recession might be optimistic, but while we think it's prudent to start thinking about a recession within the next several quarters, We know that a lot can change between now and then. Also, please see our client question, which shows that the stock market has actually increased in 11 of the last 12 Fed tightening cycles, with an average gain of 9.4%. The volatility and decline in the markets to start the year was driven primarily by fears over Fed tightening monetary policy, increased inflation expectations, and the Russia-Ukrainian War. The present environment is increasingly difficult as these three factors are creating almost a negative feedback loop to drive further volatility. The Russia-Ukrainian War is creating a lot of fear and uncertainty while simultaneously driving up commodity and oil prices and putting further upward pressure on inflation. And typically in an environment with this much volatility, the Fed would not be thinking about raising rates. They might even be thinking about lowering rates. However, because inflation has risen to uncomfortable levels, the Fed must act to tighten monetary policy. And the nervousness over the Fed's response is further exacerbating volatility and market declines. And since we expect this difficult market period to persist for a while, we're sticking with our investment philosophy of maintaining a long-term viewpoint, as the present environment is extremely challenging and fluid. We prepared for volatility last year by shifting portfolios more defensively, and given all the uncertainty, we are maintaining that positioning. On the equity side, we remain tilted toward high-quality U.S. large-cap stocks, and on the fixed income side, we continue to focus on achieving balanced stability and income while accounting for short-term cash needs. We're also using the volatility to our advantage by opportunistically tax loss harvesting and repositioning portfolios, and also selectively putting money to work for clients that have recently made contributions to their accounts. Since these volatile periods occur commonly in the stock market, we've developed a process to make lemonade out of lemons and to try to make the best of these situations. This is what we've done in the current period and past periods where the market has declined, and we expect to follow that same process in the future.
Thank you for watching today's video. And please visit our website at winthropwealth.com to view our latest commentaries.